Okay, so let's get started with technology. There is a fair amount of tech coming up for you on the show. And TCS really sets the ball rolling. It kicks off the earnings season and also, of course, the IT sector earnings themselves. So, Reema, take it away. Let's start from the top. I mean, you've been telling us when we did the overall sectoral preview that it's not likely to be a very hot quarter. In fact, we could be seeing flat growth, maybe even degrowth for some of the companies. Now, where does TCS stand in the earnings expectations pecking order? Is it likely to be at least, the best amongst, what could be a flattish quarter?
You said it, right? So it's expected to be a fairly muted quarter for IT companies. In fact, the growth rate could be the lowest since the COVID quarter, Q1 of FY21. That's 10 quarters prior to that. But what we're expecting this time, that amongst the large cap 4 IT names, TCS is likely to report the highest growth. So dollar revenue growth, 1.9%, and a constant currency revenue growth of 1%. That's on revenues. Even on margins, TCS is likely to report an improvement in margins by 50 basis points to 25%. But that said, even TCS's margins of 25% will be much lower than the post-COVID margin high of 26.85%, and it's also going to be lower than the company's aspiration band of 26 to 28%. There you have those numbers. So it's expected to be better than the others. But again, if you compare it to the kind of growth rate TCS has enjoyed in the post-COVID digital transformation boom, as well as even the margins, 26.85% was the high, the numbers are going to look a bit muted. But then again, the macros are such, right?
The macros are such, but Reema, you're saying that it is likely to be the best amongst the larger players, right? There are still concerns that the street has. Like you said, of course, it is likely to be lower than what we have seen TCS do. But what are the main concerns? Is it their sort of big exposure to the banking names? Is it the valuations are just not comfortable? What is it?
Let me give you 3 reasons. One, growth rate is slowing down. In the last 10 quarters, TCS's average growth was 3.6%. This quarter, we're expecting it to come to 1%. Right? This is about the quarter. If you look at the estimates for the next year and the year following, now this is the Kotak estimate. They're saying FY23, TCS is likely to see a 13% growth. This comes down to 7.3% next year, and then it rises to 11%. So the street is expecting that somewhere in FY24, things start improving again. But what if the uncertainty lingers on and it goes into a hard recession, US, right? Then all bets of this improvement are off the table. So concern number 1 is growth is slowing down in the current quarter and even next year. 2, exposure to BFSI, which is in the midst of a bit of a storm right now with US regional banks in Europe. BFSI exposure is 31%. And growth rates for TCS have been narrowing. And the third reason is while valuations. For TCS, valuations at 24, 25 times is more expensive than peers.
Okay. Those are the numbers, but beyond numbers, TCS also has been hitting the headlines for the other big story, right? There's a management change underway at the company. So what would you watch out for? What else is the street looking out to hear and to get to know from the company?
Well, just to simplify it, I think I'm going to give only 2 reasons. One is on the supply side, okay, attrition and headcount, because we've been reading headlines about how the supply side is improving. If that's really the case, then margins ought to improve. There is a reason why IT margins fell last year is because companies had very high attrition. They were paying a lot of bonuses. Some companies gave a double bonus, for lateral hires. They were tripling, doubling their salaries, etc. to get people. The war for talent, right?
But that's a thing of the past now.
That's supposed to be a thing of the past. Okay, so if truly things are under control, it's got to start reflecting in margin improvement going forward. Okay, particularly on headcount, last quarter, TCS's headcount declined. It declined by 2,200 employees, and in the past decade, TCS's headcount has declined only thrice. If TCS's headcount continues to decline, one, it's also seen as a possible indicator of demand slowing down. That's the reason why they don't want too much. One reason, of course, is they have a lot of people on board. They've overhired, maybe they've got enough on the bench. But the other angle could always be demand slowing down. And secondly, it's the new CEO, right? K. Krithivasan. He's the CEO designate. He takes over officially, sometime in September. But he will be chatting with us tomorrow in the interview at 8:25 along with Rajesh and NGS. So what are his priorities right now? Because from being a BFSI head, he's going to be the head of the company. How is he planning to navigate TCS? Is there going to be a big strategic change in the company? And particularly from him, of course, we'll watch for the BFSI outlook because that's where all the attention is.
Where the action is.
Where the action is,
Okay, all right, Reema, thanks very much. I think that's a pretty comprehensive sort of prep for us as we get ready for the big TCS numbers that come out later in the evening. And you can, of course, catch the management, Rajesh Gopinathan, outgoing MD and CEO, addressing the media at 5:30 p.m. That's when the company releases their earnings. That's happening on CNBC-TV18.
All right, we will also revisit the IT space later on the show. Naveen Mishra, Senior Research Director at Gartner, will also be joining us to discuss their projections for global tech spend. So we're really going to be looking at this space in some more detail. But for now, we do need to get into a short break. When we come back, we are going to shift focus and tell you what's going on with the commodities. There's a lot of action there as well. Manisha will fill us in.